In fact, there's a very interesting quote that I want to be reincarnated as a bond market because everyone is intimidated by them, right? So that's how important they are. Or bond markets are the plumbing of the financial system. So all the money flow actually is sitting on the bond market.
There is the central bank rate which is saying the rate is X, and then there is the bond yield which is actually the consensus view of the market.
Bond market therefore have very large role in terms of conveying what the market or the investor expectations are to the entire economy. Equity markets take a lot of cues from the bond market in terms of what are the expectations, what are the discounting rate, etc. But they are not really driving the financial system as such. So that's why I think the bond markets are more critical than equity markets.
Hi, and welcome to another episode of Open Dialogue. Globally, bond markets are typically much larger than equity markets. Bond yields determine many macroeconomic parameters, including interest rates, growth, and the like. Bond yields also determine how equity markets perform. Today's episode focuses on this aspect of the market, which is very large, very important, but not necessarily that well understood. Joining me for the discussion today is Ashish Gupta. Ashish, welcome to the show.
Thanks, Shetty.
Great. So Ashish, to start with, if you can just describe the bond market. What are the components? How big is it?
Sure.
And how does it operate here?
So first let's distinguish between rates and bonds.
Right.
So rates, and I'll put rates in two categories. One is the policy rate. And second is what I call real life rates. Right? So policy rate is what the central bank of a country decides. Right? So in India, it is the repo rate. In the US, it is the Fed funds rate. Right? And this is really a signaling tool, right, of central bank's direction of policy. And basis this, typically you'll have bank determining the real life rate, which is what you and me feel in our day-to-day life, right? Which is the rate of interest a bank pays on my deposit or the rate at which I borrow from the bank. So the real life rates are the deposit rate and the lending rate, right? Another aspect is really the bond yields, right? So bond yields are actually the price or the rate investors demand to hold the bond, right? In a sense, if you want an investor to give you 100 rupees, what is the amount of money that you need to pay him for, right? And again, this rate is different for different duration or time period the bond is for. So if it is a 1-year bond, what is the amount of return the investor is expecting? If it is a 2-year bond, what is the amount of return that he's expecting, right? And so rate is essentially set by the central bank. It is typically overnight rate. In India, the repo rate is the rate at which central bank or RBI in our case will give money to a bank. The Fed rate, on the other hand, is the rate at which in the US banks will give reserves to each other, right? Not the Fed giving them reserve, but banks will give reserves to each other again for the overnight. So the Fed rate is again just an overnight rate, right? And this how it translates to deposit or lending rate is what is we call as the transmission mechanism in the banking system, right? For one, it can be seen as the incremental or marginal rate because a bank is already raising deposits at whatever price it can. So if it wants one additional rupee, it needs to go to RBI to borrow it. So if that cost of that money is going from, let's say, 5% to 4%, then banks' incremental cost of funding is falling, and then it will say that, okay, I can lend money at a lower rate because I can get 1 rupee at a cheaper price, right? So it's, or you can see it as the opportunity cost of money, right? So or rather than paying a deposit of 5%, it says it's cheaper to borrow money at 4% from RBI. So why should I pay the deposit of 5%? So it lowers the interest rate. So this way it kind of starts to reflect in the deposit rate and the lending rate. Bond yields or bond rates are actually a bit more complex than that, because the difference is that when a central bank sets rate, it has certain consideration. It is looking at most central bank, the first parameter they look at inflation, the second dynamic they look at is growth, and then there will be other parameters, whether it is exchange rate, banking system stability, etc., or even liquidity, right? But when a bond investor, when an investor is looking at a yield, he is looking at inflation expectations, it is looking at growth expectations, it is looking at stability expectations. So the factors that go in determining bond yields are many more, and in one sense you can say it is reflecting of market expectations, right? So central bank may set a rate, but bond markets may not react to the central bank rate because market expectations are different from central bank's goals.
Great. Very interesting to understand, Ashish, which is there is the central bank rate, which is kind of one entity saying the rate is X, and then there is the bond yield, which is actually the consensus view of the market. It is not any one individual saying X or Y. Typically, the two are kind of linked. If the central bank raises rates, then typically bond yields you should see rising. But this equation is not mandatorily always the case. In sometimes sometimes the bond yields may go up. In fact, most times bond yields will go ahead of the announcement because they are expecting the announcement to come. And there is very little reaction afterwards. Sometimes actually they don't react at all because their expectation of other economic factors are
and sometimes we have seen inverse correlation.
Inverse correlation as well,
and there are several examples, right? So even this year you see in India the central bank cut rates and actually the bond yields have gone up. So bond yield today are 25-30 basis points higher. If you look at last year in the US, Fed cut rates from 5.5% to 4.75, and earlier in the year US 10-year bond yield was about 3.6, 3.7%, and actually it moved to over 4%. Even today, when the US Fed rate is 4%, you have US bond yields more than 4%. So they don't necessarily move in sync.
In the same direction or in sync, correct. Great. So maybe before we come back to the markets and so on and so forth, just maybe understand this a little bit. So first is the bond yield. It's actually, even in the bond, there is a rate and there is a yield. There is a coupon and then there is the yield. So one will be helpful to understand what is yield actually. And how do you calculate yield and what it means.
So yield is basically the return you get for holding the bond, right? Now, coupon is the interest rate, but interest rate is calculated on the face value of the bond. Okay. So let's take an example. A bond has a 9% coupon. When it is issued, let's say it's issued at 100. So the rate of interest on the bond is 9%. Right. Now, for whatever reasons, when it starts trading in the market, its price falls to 90 rupees.
Right.
So as an investor today, if I buy it for 90 rupees, I will get the 9% coupon. So the yield for me is 10% because I'm getting 9% not on 100 but on 90. Right. So the bond yield is actually 10%. So what the market has said is that for holding this piece of paper, which is from a certain issuer, I want a yield of 10%. 9% is not good enough. That is why the price of the bond had dropped from 100 it was issued at to 90.
Right. Great. So yield is basically, it's a moving metric along with time. The coupon is fixed basis at whichever time the paper was issued. And very interestingly, actually, if you look at bond markets, they don't quote prices, they quote yields. Like equity market quotes prices. You can buy an Axis Bank share for X rupees today.
Yes.
But if you were to buy Government of India bonds or even Axis Bank bonds, they would quote a yield and not quote a price, because actually the price in itself is not relevant. It is the price and the coupon which combined kind of show the value, which is why the quotation happens in yield. Now, what determines yield?
There are several factors that go into calculating yield, right? And let's look at it another way, right? If an investor is buying a particular asset, right, yield is the return he demands on that asset. Okay?
Right.
So let's assume that today 6% is the policy rates set by the central bank, right? So the minimum he will demand is that I get 6% on that asset. Now, on top of that, you will have certain expectations. So if the bond is not overnight, right, it has a certain time period. Let's say if it's a 2-year bond, right? So he will look at what is the interest rate today, what will be the interest rate 1 year later, right? So, and if expectation is that for this year, interest rates that you'll get in a bank is 6%, but next year the interest rate will increase to 7%, right? So if I want to buy a bond for 2 years, I'll say that if I make a 2-year investment at 6%, I will lose out. I'm better to make 2 investments, one now, one a year later. So on average, I'll get 6.5%, right? So then you will demand extra money to hold it for 2 years, so that you kind of take the expectation of future interest rate into account, right? So that so interest rate today plus future interest rate come into your calculation at what yield you want. Another thing would be what is the liquidity premium, right? So today if I invest for 1 month or if I give you money for 1 month, but if I want to give you money for 3 months, I'll want a slightly higher return. So there's certain liquidity premium that comes into it. Another factor that will kind of come into it is that if I'm giving you money, how sure I am that you'll give the money back, right? And so when particularly if it is a corporate bond, then you start thinking that what is his credit rating, right? So if I'm giving money to someone who's rated AAA, very likely that I'll get the money back. I may not ask for lot of premium over the rate. But if it is someone whom I am not that confident, right, I will ask a larger premium, and that is called the credit spread, because I am giving money, there's certain risk associated with it, so I am asking for the higher return. Now, interestingly, even when people are buying government bonds, so typically if you are in a country, you're lending to the government, you don't feel that there's a credit risk lending to the government, but investors still feel that there is certain risk associated with the government. That risk could be reflecting how fiscally responsible the government is, because if the government is not responsible, then it will continue to issue more and more debt. Right? So there will be more supply of bonds in the market, and therefore the price of bonds will keep coming down. Right? So the growth in the economy, the fiscal discipline of the economy also go into building that out. So net, there are interest rate expectation, inflation expectation, your demand supply of bonds, the macro characteristics of the economy, and on top of it, if it is a non-government issuer, the credit spread are things that kind of build up into a bond yield.
Great. So just again, because there's a lot of things that came in here, so just
Sure.
to repeat in my language. First, we'll split the kind of technical components and factors which determine. So technical components, there are four, I think. First is the interest rate curve itself, which is the point you made is that if the repo rate, as an example, is let's say 5%,
Yes.
just making up a number. If it is 5%, the repo rate is a overnight rate.
Yes.
Right. Whereas the bond likely is a 1-year bond. There is no one-day bond. So
Sure.
it's likely a 1-year bond or a 10-year bond or a whatever, right? So let's say it's a 1-year bond. Now, if the repo rate is 6%, the 1-year bond most likely will be higher than, we will come
Sure.
to the exception cases where it
Sure.
is lower, but most likely it will be higher than 6% for two reasons. Reason number one is the liquidity premium that you said that, if you are kind of giving money for a longer period of time, you will want a higher return. But number two is the interest rate expectation itself, which is today RBI, so you could either put money into a bond for 1 year or you could do repo daily for the next 365 days.
Yes.
In a theoretical world, the two should give you equal outcomes.
Yes.
Right? And so, if you expect that this rate is going to change, then this rate, the 1-year rate will change.
Absolutely.
So, at some level, the 1-year rate is or the 10-year rate is telling you what the future expectation of
Yes.
interest rates
Yes.
is, which is linked to inflation, which will again come to
Yes.
separate. So, one is this, what the interest rate curve looks like. Second is the liquidity premium, which we already discussed. Third, there is a credit spread on top for credit entities like corporates and so on and so forth, because the rate at which the government of India can borrow versus the rate at which, let's say, a triple entity can borrow versus the rate at which a double A or some entity can borrow are very different.
Yes.
Because there is associated credit risk. So these are the technical factors that go into this. From what all impacts this, obviously, so A is inflation expectations. If the inflation expectation is high going forward, then the going forward rate is
Higher.
that much higher, because you, as a investor, you want to be compensated for the inflation.
Yes.
So if you expect inflation is 3%, then you want 3% plus 2%, let's say. But if the inflation is 5%, then you would want 5% plus 2%. So that your expectation of inflations would impact it. Linked to it is also the issuance of debt. If you expect the government to issue a lot of debt, because the people, I mean, it's all demand supply. The amount of money which is looking to buy bonds is pretty much fixed. If the amount of bonds is more, then the price will fall. If the amount of bond is less, then the price will go up.
Yes.
And so the expectation of issuance also determines this. All of this will cover in more detail, Ashish, as we go through, because each of this is fairly intricate and very involved. So let's start with the relationship between inflation and interest rates and the yields, and what that implies.
Sure. So I think that is a very simple relationship, right? Inflation actually tells you how much of your money you are losing.
Yes.
Right? Or how much of your spending power you are losing in the money, right? So let's say if I have a choice of buying these flowers today for 100 rupees and 1 year later they'll be 110 rupees, right? So I can either buy these flowers or I can put money in a bond or in a bank, right? But then I want my purchasing power to remain the same, so that 1 year later I can at least buy the same thing. So if the inflation is 10%, the minimum return that I would seek is 10%, right? And that kind of translates into change as well. So if the inflation rate goes up, I would want a higher return. Right? So if inflation, so these flowers will 1 year later become 115, then I would want that, okay, rather than buying now, if I'm delaying my purchase, after 1 year, the bank should give me 115 so that I can go back and buy these flowers. So I think that correlation is a lot more intuitive, that if inflation is going up, interest rates in the economy will go up. Where it gets interesting is that this also drives reactions, particularly from the central bank, right? Because one of the objectives of a central bank is to have certain degree of price stability, right? And interest rate is a tool it uses along with liquidity to achieve price stability, right? Why does a price go up, right? Price goes up because a lot of people want the same thing, or there is more demand, right? And as we discussed earlier, the rate central bank kind of decides leads to transmission into real life rates. It is the rate at which people will borrow money and more particularly lend money at, right? So if interest rates in the economy start going up, lending rates start going up, less people will be able or willing to borrow, right? So your aggregate demand starts to moderate. If aggregate demand starts to moderate, the price people are paying hopefully starts coming down. So interest rate actually are a reaction also to inflation. So if inflation is high, interest rates will also go up, because likely that central bank will act to raise interest rates to reduce demand so that prices start to cool off.
Right. So firstly, the correlation is inverse. Higher the
Correlation is direct.
yeah, correlation is not inverse.
Yes.
Correlation direct. Yes. Higher the inflation, higher the
Yes.
interest rate. For two reasons. One is, if the inflation is high, people would not like to, postpone their purchases.
Yes.
Because tomorrow you don't know whether you will get the money tomorrow. So the incentive to postpone purchases has to be higher.
Yes.
And the incentive to postpone the purchase is the interest rate. So
Yes.
so it has to be higher. Secondly, also, if the inflation is high, then at some point the kind of government, central bank will come in and they'll try to cool the economy. The way to cool the economy is to increase
Yes.
benchmark rates.
Yes.
So that borrowing becomes, like, benchmark rates go up, borrowing becomes expensive. Borrowing becomes expensive. People are not borrowing so much, so they are not spending so much, and hence the economy cools down. On the other side, even from a supply side, for corporates to borrow also becomes expensive. Then they raise prices,
Yes.
or they reduce production because they don't want to take so much debt. And so again, the supply also, ensures that the inflation comes into focus. So this thing is linear. The second important point you made is that actually the interest rate is not linked to today's inflation. It is linked to your expectation of the
Yes.
inflation going forward.
Yes.
So maybe today's inflation is high, but if you're expecting inflation to reduce, then the interest rates will be,
Yes.
the yields will be
Yes.
lower as you.
And particularly what you referred to earlier, some of the exception cases in which long-term bonds are at yields which are lower than what short-term bonds are, right? So earlier we spoke about an example where interest rate this year is 6%, next year is 7%. So I will demand, if I am investing in a 2-year bond, I should have at least 6.5% interest, right? Let's kind of take a different example, that interest rate today is 6%. Next year I expect inflation and therefore the interest rates to come down, and next year I expect interest rate to be only 5%, right? So then I'll say that I'm okay to have a 5.5% interest for the 2-year period. So if I buy a bond for 1 year, I want 6%, but for a 2 year, even a 5.5% yield will work, right? So there, what it called is inverted yield curve. So yield curve is just bond yields for different maturity of bonds of different time periods, and typically it is sloping upwards. Inverted means that it is going downward, that a longer duration bond is trading at a yield lower than current year's bond, and it is typically because you expect in future inflation to be lower. So if your inflation expectations are lower, your rate trajectory could be lower.
Great. So thanks, Ashish. So can you help us understand, like, there is this, you hear a lot that the bond markets are very critical, and perhaps more critical than the, let's say, the equity markets. So why is that the case? What kind of makes them so important?
Sure. In fact, there's a very interesting quote. I forget who it is from. He was advisor to Bill Clinton, and he actually once said that I want to be reincarnated as bond market,
Right.
because everyone is intimidated by them, right? So that's how important they are. So I think the reason is clear, that all the modern economies really function on bedrock of the financial system, right? And in the financial system, plumbing, bond markets are really, or bond markets are the plumbing of the financial system. So all the money flow actually is sitting on the bond markets, right? Because if you look today, for example, in the US, the bond market is nearly $50 trillion worth, right? Corporate bond market is about $12 trillion worth. Government bond market is about $35 trillion worth. And in the US, bank lending to corporates, commercial lending is only $2 trillion, right? So most of the commercial ecosystem in the US actually gets funded out of the bond market, right? Even if you look at the banking system, right? The banking system itself relies largely, not largely, but to a great extent on the bond market. And particularly if you look at the investment banks, JP Morgan, etc., Morgan Stanley, 25 to 30% of their funding is from the wholesale market. It is actually coming from the bond market, right? If you look at the government themselves, right? Most of the governments now run in deficits. US runs, US government borrows $2 trillion annually from the market, right? So in a sense, bond market actually determines the behavior for each of these people. So if the bond yields start spiking, there will be no choice but the government to kind of start pulling back on its expenditure, right? So bond market is in a sense dictating terms to each of the players. If you recollect in 2008 when the global financial crisis happened, the reason why it happened was that these markets broke down, right? Because people lost faith in mortgage bonds, right? People were not willing to, because they were unsure of the ability for those borrowers to repay, those mortgage bonds lost their value very, very quickly. Right? And when they lost value, people holding those bonds could not transact them. It came to a point where the banks who were holding these bonds, people became wary of transacting with those banks, right? So the reason banks went under because the bonds they were holding, people were not sure what the value is, so people did not lend to the bank. So it's a cascading impact that happens, right? So in a sense, bond markets really dictate, and if your yields go up, it is really signaling that market expectations are that you are not as credit worthy. It is becoming riskier to lend to you, and it's kind of a self-fulfilling vicious cycle, right? Because higher your rate goes, you are more desperate to borrow money, you will push up rates, and it kind of cascades on itself. In fact, this year itself, if you remember in April, when Trump first announced his tariffs, right? You saw US 10-year bond jump from 3.9 to 4.5%. And within 48 hours, he came back and rolled it. So it actually led to even Trump kind of very quickly moving back on his announcement. So I think bond market, therefore, have a very large role in terms of conveying what the market or the investor expectations are to the entire economy. Equity markets take a lot of cues from the bond market in terms of what are the expectations, what are the discounting rate, etc. But they are not really driving the financial system as such, right? So that's why I think the bond markets are more critical than equity markets.
Right. So bond markets, basically the entities participating are far more interlinked, and a lot of the transactions between financial services entities is happening. The lending and borrowing is happening via the bond market, and if something goes wrong, it very easily spreads to many more entities. And those entities, by the way, themselves are in the foundation of the economy, like banks, etc., are pretty much the foundation. So if something wrong happens, it very quickly impacts the overall economy, and which is where it becomes super critical.
And this is not just linked to institution, right? This even goes into economies,
right?
And so there have been several cases in history where actually bond market spike or bond yield spikes have actually led to crisis happening in countries, right? So if you go back to the Asian financial crisis of 97, 98, right? So that time, and that's another example of actually Bank of Indonesia cut its interest rates, right? But rather than that leading to a drop in bond yield, the bond yield spiked, right? And there was a massive devaluation of the currency. I think the currency lost like 70-80% in a matter of weeks, right? And because people saw that there was not just inflation risk, right, but there was a default risk that was building up. There were concerns about the banking system, opacity, etc. So actually you saw the risk can not just be on entities, but even on governments if the yields are spiking.
Absolutely. Now Ashish, moving on this, there is this correlation between the bond market and the equity market as well. Typically, they run in opposite directions. So why does that happen?
So I think that's used to be the theoretical construct, and one of the reasons was that historically it was believed that investors have two asset classes, bonds and equities. If money is going into bonds, it's coming out of equities, and vice versa, right? The other reason is that you assume that the both are traded rates, right? As we spoke earlier, bond yields are actually signaling expectations, right? So, and expectation is what drives equity markets as well, and bond yields are also reflective of future, right? Like equities also price in the future, right? So in case of bond yields, so if bond yields are going up, right, and that means bond prices are actually coming down, right? And but if bond yields are going up, how do you price equity, right? Equity, as you know, is the longest duration asset, and to value any asset, you discount the cash flow. So if bond yields are going up, typically equity prices should also come down, right? So rather than inversely correlated, it signals that they are directly correlated. And the impact on equities of rising bond yield will be even larger because it's the duration with the maximum, it's the asset with the maximum duration, right? So, so one is just the way the discounting works. So if bond yields are going up, your discounting rate is going up, and that means prices come down. But this is simplistic. One of the questions for this is, like in equity markets, there are investors coming from multiple parts of the world, right? There are investors in India, there are investors in the US. As an investor in India, I'll say bond prices in India is my relevant discounting rate, right? If a US investor is investing, he'll say, I don't care what's the bond rate in India, it's the US bond yield that is right? So it could be that which bond yield you take for discounting. An Indian investor will take Indian bond yield, US investor will take US bond yield. There could be other considerations, right? Why is the bond yield going up, right? So is the bond yield going up because inflation expectation is increasing, or is the bond yield going up because growth expectation is increasing, right? And that has very different implications for equity, right? Because equity is a growth asset. So if bond yields are going up because your growth expectation is going up, then actually equities will also go up despite the rising bond yield, despite the fact that discounting rate is going up. But if the bond yield is just going up because inflation is going up and therefore interest rates will be higher than your growth will be the same and discounting rate is then actually equity prices will come down. So it depends what are the drivers of that change and where you are in the cycle, right? So early in the cycle, when interest rate, even when the central bank is raising interest rates, actually equities continue to do well because at that time the growth rates are strong, right? It's only when interest rates start to bite and growth rates start to come down, that's when actually equity markets react more negatively to rising bond yields.
Right. So basically, if you put it very, very simply, if I have 100 rupees and I have one equity and one bond to invest in, if say the yield is 5% and if the price is 100 rupees and I make a choice, now if the yield goes from 5% to 10%, this kind of becomes far more attractive than this, and so this price should ideally come down because I will take money out and put it here, and vice versa. Very simplistically put. Having said that, as you rightly said, it depends on why the yield went up from 5 to 10. If the 5 to 10 is because of expectation that the government is profligate and suddenly now inflation is going to go through the roof, then equity prices will also fall. But if the interest rate has gone up because people are saying that look, a year from now the growth rate is going to be very high, and hence inflation is driven off that growth, and so it's a very kind of positive kind of a thing, then we may find both also go in the same direction. In any case, the two markets are closely linked, and looking at the bond yields can give you interesting insights about future path of equity.
Yeah, because as I said, both are based on expectation, and bond yield is kind of summation of expectations around inflation, about growth, about credit worthiness, and that kind of feeds into the economy, right? And each of these factors is important, right? So even when we spoke about the credit spread, so credit spreads is the extra money you want for to lend to someone who's not government, right? So if it's AAA borrower or BB, so if it's a strong economy, you'll expect the credit spreads to come down, because you will feel that if the growth is good, even not so great guy will be able to pay you back, right? So when the credit spreads are low, that is a signal that economy is doing well, growth is going to be good, and therefore you will find that equity markets react positively to that. If the credit spreads are widening, that's an indicator that economy is potentially slowing. People are expecting defaults to rise, and therefore equity markets will react negatively to it.
Right. So we spoke, Ashish, about, let's say, the Indian bond yields and the Indian equity market. But lots of Indians follow the Fed very, very closely, right, and the US bond markets. So what is the linkage between rates in the yields in the US and, let's say, Asian markets or emerging equity markets?
Sure. See, I think over time this correlation has come down. I think India, other emerging markets, much more so, used to be a lot more dependent on foreign capital flow.
Right.
In India, the debt markets, particularly debt markets, have never been very exposed to foreign flows. So at its peak, less than 5% of Indian bonds were owned by foreign investors. The number is less than 2% today, right? So directly, there is no correlation because foreigners don't own much of Indian bonds, particularly government bonds, right? In other markets, emerging markets, if you take something like Brazil or Indonesia, government plus corporate bond, almost 40-50% of that market is owned by foreigners, right? So then there is a lot more direct correlation, right? Of course, that is in terms of stock. Also, what policymakers think about is flow, right? So, how is capital flowing? So, if bond yields in US, for example, are going to be rising, then naturally you will potentially see more money gravitates to the US. And if we kind of think of US as a reserve currency or the home market, so people will demand more return if they are bringing money out of a market where in dollars you are anyway getting 5 or 6%, right? So it impacts the flow of money. So rising bond yields mean that potentially flow of money, if not in debt, even in equity markets, is going to be lower if US interest rates go up, flow of, and vice versa. If US interest rates go down, you will see money moving out and trying to search for yield or return in other asset classes, including India. Now, over time, this equation has changed. Vulnerabilities have changed. I remember in the last decade or so, only once, I think it was 2022, May, June 2022, when RBI actually conducted its monetary policy. So they called for an unscheduled meeting one day before the US Fed meeting, right? And they raised by 40 basis points because that was the time US was kind of going to, US Fed was going to change its stance. So US next day raised, Fed raised rates by 50 basis points and actually also started quantitative tightening. So before that, US was Fed was buying bonds and then actually it stopped buying bonds, right? So I think except for that, we have seen RBI conduct its monetary policy very, very independently. If you see the spread between US rate and Indian rate, that has varied. So in the last 15 years, it has gone from 600-700 basis points to like 150 basis or 200 basis points now, right? So it's not a like for like, right? Because over time it has come down so dramatically. But at points of time, they do correlate, the flow does correlate. And in India, actually, it's not so relevant for the domestic bond market because there are not much foreign investment, but more so for the equity markets where even now, so over the last few years, ownership of foreigners in Indian equity market has come down, but it is still around $900 billion, right? So it's kind of an important determinant of that.
So, in short, basically, if the US yields fall, then Indian equity becomes more attractive, everything else remaining the same, and hence you should see some flows coming in.
Yes.
And vice versa, obviously.
Yes.
This equation was very strong at one point in time. Like in 2008, India frankly didn't have the challenges that US had.
Yes.
But India was amongst the worst performing markets because a lot of the investors were US based and basically they pulled out money just to manage liquidity, etc. back home. So, but that correlation has come down dramatically, but it still continues to exist. Great. So, two kind of other angles I'll take, Ashish. First one is this, and we covered a little bit in the past, which is this notion of this inverted yield curve. And like one used to hear that the strongest indicator of an upcoming recession is an inverted yield curve. So just help us understand what is an inverted yield curve and why it is supposed to be so dangerous.
Yeah. So I think as we talked about, yield curve indicates the future interest rate levels, right? And an inverted yield curve means that a longer duration bond or bond with has a maturity longer than another bond is trading at a yield that is lower than the shorter maturity bond, right? So maybe simpler to use an example, a 3-year bond yield is 5% per year, while a 1-year bond yield is 6%, right? That will only happen if you expect that after 1 year rates will be lower than the 6% rate today, right? Now, why will it be lower? Is that in 1 year later, you expect, let's say, the central bank to cut rates, right? And why will central bank cut rates? Because it is seeing that growth in the economy is slowing, so it is expected to take action to revive that rate, right? So that's really the theoretical construct which economists have, that an inverted yield curve means that there is going to be a recession in the future, because that is the reason why central bank will be cutting rates in the future, and that's why you are willing to take a lower rate on a longer duration bond today than you are willing to take for a shorter duration. But as they also say that economists have predicted 10 out of the last 5 recessions, right? So it's not a foolproof indicator. There are always lots of false indications as well, but at least that's the construct.
Understood. So the only reason why the yield curve, so yield curves are typically positively sloping, because of even if you were not expecting interest rates to rise, it would be positively sloping, because to keep money for a longer time, you will expect higher returns, so that you can keep refinancing, but if you are giving it for longer, you would expect higher return. So the natural inclination is that you expect a higher return in the future than, like, longer the duration, you expect the higher return. So the only reason why the yield curve would invert is you are expecting the rates to fall significantly, which is an indication of the economy slowing significantly.
Yes.
And hence it's an indicator of recession. It doesn't happen too often that the yield curve is inverted, but there are many occasions and many false positives as well. Particularly in the last 3 years, I think we've seen many indications of the yield curve inverting, but economy seems to have done quite well. Very helpful. The other direction I wanted to take this a little bit is, we spoke about crises, and particularly you mentioned the East Asian crisis. So if you can help us understand, like, let's take one of these and just help understand what happened and why did it result in a crisis, and through that obviously all the other interlinkages.
Sure. So I think typically you will see bond markets, particularly the aspects of market like the term premium. So term premium is how much more return you are demanded for keeping the money longer, right? So if you so we spoke about the yield curve is positively sloping. So if you are giving money for 2 years, how much higher premium you are wanting? As you said, because the longer you keep, the period of uncertainty for you is more, so term premium is typically positive, so you are wanting more money. And credit spreads, right? So these are the two things that build on in terms of the central bank rate to determine the bond yield, right? And both these can be seen as a gauge of fear or gauge of uncertainty, right? So if bond yields spike, right, it could be because of either of these reasons, right? So if we go back to 2008, the credit spread widened, right, because people were unsure what is the default risk on a mortgage securities, right, and that kind of led to yield spiking, right? There are other cases where the term premium, right? So if you are keeping money in that case in Indonesia, or you go back to the Argentinian crisis, or I think 92, 94 in UK when George Soros kind of. So at that time, you had a spike in yields where the term premium increased because people were uncertain of keeping money in that currency, because you expect the currency to lose value.
Right.
So it could be because inflation could spike, it could be because the currency will get devalued, right? So any of these spiking is indicate that market is fearful that these factors are not in the control or are not stable, right? And therefore it is always precedes crisis that happens, right? And it starts to indicate that something is going wrong in the parameter. So either your credit risk will spike or your term premium will spike. Because the expectations are that either the government has let loose of its fiscal policy, or the inflation is getting out of control. There's a policy risk in which you'll have a devaluation of the currency, or borrower is going to default.
Right. So, in the case of the East Asian, I kind of you referred this earlier. In the case, I mean, these are bunch of countries in Southeast Asia, all export oriented. Actually, a lot of the capital was global, which came in, and there's a lot of money that came in. There was over exuberance, if one may use that word. And at one point in time, suddenly people realized that we have this issue, and people started pulling money out, and that's where the yield started to kind of go out of control. Which, by the way, obviously many of these countries had massive issues. They had many years of economic slowdown subsequently, but at the same time, this issue spread to the US because we had this long-term capital management which was investing.
Yes.
It was a fund run by 4 Nobel laureates, and they were hugely profitable. They were placing bets on the Southeast Asian and the Russian bond markets, which went through default and the like, and so they went bankrupt. And there was at one point in time worry that bankruptcy would spread to the US banking system, and the Fed had to step in and the banks got together and found a way to resolve the situation, and LTCM went bankrupt. So interesting use case of how these are all correlated and how these things.
And in fact, if you look at the bond market, right, and this happened in the GFC as well, right? So you need credibility to be restored, right? So in GFC, for example, the MBS market, the mortgage security market went down because banks were holding it. People were not willing to lend to the banks, so credibility of the banks went down, and it kind of got replaced only when banks' credit rating was backstopped by the US government.
Right.
Now, in case of Asian countries, right, the credit standing of the government was not sufficient to kind of backstop their banks, right? So, because the government's own bond yield spiked because people did not believe the government or people did not believe the currency. So, and today, some commentators are now questioning that, right? So the devaluation in the dollar you are seeing is reflecting that, right? So, if market goes down, then you have banks who can backstop and provide a guarantee. If banks are not being believed, then the government goes in and backstops the bank. The biggest risk comes when the markets don't believe the credibility of the government, right? And that's when the currency gives way, right? And that's where we are. There are questions around. So US has been the reserve currency for so long because that's the belief in the credibility of US government, US Fed. But as that has started to diminish, you are seeing today a divergent trend when US Fed is cutting rates, and from 5.5% last year, now we are at 4%, and US bond yields have actually gone up by about 75 basis points.
Very interesting. The other one, by the way, comes to mind is the UK episode.
Yes.
Wherein actually a prime minister lost her job, right? So maybe if you can just also run us through that and what happened there.
Yeah, so in the UK in '92 there was currency peg. They were kind of maintaining a certain peg for the level for the pound. UK economy was continuing to weaken, and they were not changing the currency peg. Right? So a lot of time, currencies and free floated currencies are seen as automatic stabilizers in the economy, right? At the base of it, exchange rate between two countries should really reflect the inflation differential in the two countries, right? So if let's say at the start of the year, you are, let's say, European country and I'm India, exchange rate between us is 1:1, right? And you have 5% inflation and I have 10% inflation, right? So purchasing power of my currency has actually relative to your currency dropped by 5%. So that should be the change in the exchange rate, right? And in a trade world, what that means is that if my currency also drops by 5%, then I continue to be as competitive as I was at the beginning of the year. If our relative value of the currency does not change, right? So I maintain my currency at the same level as your currency, then my competitiveness has come down because my cost of production has increased by 10%. Your cost of production has increased only by 5%, right? So you will now be able to export it cheaper than I would, right? So kind of currency or a freely floated exchange rate acts as a stabilizer, right? Now, if someone pegs the currency, right, that's the time when he is kind of telling the market that my fundamentals are not changing. And that time, I believe George Soros bet, I forget the number, billions of dollars. I know he made a profit of $1 billion from that trade. He bet that because UK's finances were weakening, growth was falling, the currency peg would break. And in fact, in 1992, first UK to maintain the exchange rate, raised their benchmark rate from 10 to 15%. And despite that, the pound actually continued to drop. Then they cut the rates, the pound dropped faster, and then they had to actually break the peg.
Right. Very interesting episode, Ashish. And actually, more recently, UK has had another episode wherein after Liz Truss became the Prime Minister, they introduced a program which was heavy on spending.
Yes.
And then the bond markets reacted. And actually, their pension agency was close to default.
Yes.
They had to take, extra measures just to stabilize the economy and stabilize and, kind of ensure that entity doesn't go default. And subsequently, the finance minister had to resign, and finally, by the way, the prime minister herself had to kind of resign, and then we had the new prime minister come in. So goes to this your initial point of everybody fears the bond market. So now we have had Liz Truss who has lost her job, President Trump who's had to revoke his tariff announcements just because bond markets kind of acted weirdly. So indeed it is the entity that everybody fears, I guess. The last question, Ashish, where are we today? What are both the global and Indian bond markets telling us?
So I think bond markets are relatively benign today. If I look at credit spreads globally, they are relatively low, and even though we have had certain degree of volatility both in geopolitics, trade, equity markets over the last 12 months, there have been sell-off. But one thing we have seen is credit spreads have not widened, and credit spread in the US, there's a category called junk bonds, which are low rated bonds or high yield bonds. They have also not widened. So I think on the credit aspects, the bond markets are kind of very, very comfortably placed globally. In no market we see that as a challenge. We had some challenge in Chinese high yield markets, but that has also kind of played through a significant extent, and those markets are recovering. On the interest rate cycle, we actually are seeing a bit of dichotomy today. We are seeing actually inflation in the emerging world being a lot weaker than it has historically been, and most emerging market central banks are maintaining or cutting rates. US actually is kind of an outlier, where actually they are cutting rates even as inflation continues to be higher than their stated comfort level, right? So they target 2% inflation. Inflation is running at 3%. They've already cut rates, and they have announced that they will be cutting rates further. So that is the piece everyone is watching very intently. But again, as we said, while the Fed is cutting rates, US bond rates are not coming down, right? So the bond yields in the US are actually staying stable, and as Fed has cut rates, we have gone from an inverted yield curve to a flat yield curve. And if now the rate cuts happen, Fed rate cuts happen as expected over the next 6 months, you will actually again have a upward sloping US yield curve. So bond markets are relatively benign. They are not kind of signaling any reds at the moment, either on the credit spreads or the term premiums.
Great. Ashish, thanks a lot for that conversation. We covered a very wide spectrum. We started with the difference between the yields and the rates. You explained to us very nicely what yields are, how various components of what determine yield, and most importantly that the yields are a function of expectation of interest rates and the confidence in the entity which is borrowing, which is in many cases it is the government. It is also a function of the supply, which is also linked to inflation, which is what is the expected supply of bonds from the government. So yields kind of are a function of all of these things. We spoke about the importance of the bond market, and we spoke about how this is almost like the blood supply of the economy, and so bond markets are in the center of that, because all financial entities are involved here, and all the fund flow that is happening through the bond markets is happening through to the financial entities, including banks, and any issue in the bond market results in further spreading of that issue to all kinds of parties. So if the yields go up, government's expenses go up, which means then they have to reduce their expenses. If the bond markets behaves badly, then it impacts the banking system, and if something impacts the banking system, it impacts the overall economy. And so bond markets are really central. Bond yields also have an impact on equity, and while they are not necessarily always correlated, but the bond market gives great insights about future expectations, and equity markets also drive of future expectations. So there is a kind of an interlinkage, and you can derive a lot of insights on the bond markets. There are many crises that we spoke about, which have emanated from the bond markets. We spoke about the Southeast Asian crisis. We spoke about the UK. We spoke about how Trump had to, go back on his tariff announcements within 48 hours because of how the bond market reacted. And so that's also very interesting to understand. And finally, you described how, if you look at globally today, bond yields are quite stable. They are actually quite benign, and they are not flashing any red signals anywhere. There are some Actually, as you said, it's a little contradictory situation where emerging markets seem to be low inflation, low yields, and many banks are either holding or cutting yields. Whereas we have the US where the central bank seems to be cutting yields, but the bond yields are high. Typically, it's typically you have the other way situation
Yes.
wherein the developed markets are low inflation, controlled yields, and so on and so forth, and the emerging markets have runaway inflation and
Yes.
governments panicking on how to control. But we are in an opposite direction. Having said that, even in the US, it's not like any red signals are flashing. It is nonetheless interesting situation. So that's kind of a summary of our conversation, Ashish. It was a fantastic one. Thanks a lot for joining us, and I hope you had fun.
Yeah, thanks, sir.
Thank you.
I hope you enjoyed this as much as we've enjoyed bringing it to you. Really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.